Hi, this is Ernie again. I'm the guy who had 6,000 in his checking account to now having millions of dollars. Today, I'm going to answer two questions that I've been asked quite often by some of my followers. One, what do I think of Oklo, O-K-L-O? I don't even know if I'm saying the company name right. Two, why do I not sell put options to make money rather than buying shares of stocks or ETFs and then sell calls against it? So again, this will be able to answer both questions. So let's dive in. So back in October 21st, when I think one of the data centers said they want to consider utilizing nuclear reactor, modular or small scale nuclear reactor to power their data center. So I started looking, and one of the companies that I came across was OKLO. It was trading around $20 after it popped. I decided to spend about $20,000 and acquire 10,000 shares, or actually acquired 1,000 shares. So this is when I acquired it. Somewhere here, around $20. And this was a perfect stock, in my opinion, because it just went up and down, for 3 months without really doing much. So utilizing my call options, I try to reinvest and accumulate as much as possible until I saw this particular pattern. And this is called what we call cup and handle formation. So this is the cup and this is the handle. And when this happens, by the way, you should Google a lot of the formations. It does not mean 100%, but many times there's algo trading. There's a lot of like technical analysis people do. But when it's a cup and handle, it typically just spikes, goes up. So because of it, I ended up not selling call options when there was a cup and handle formation, knowing that it's going to spike. But last week, I sold my calls at $40. So I doubled my investment. But because it went above 40, it closed at 41.82, I ended up selling my shares at 40. Typically, I would go back and buy it again and sell call options all over. But this time around, I'm not going to do that. And the reason is this. This bottom portion is called RSI. When it's below this yellow bar, that means it's oversold. Like people panicked and just sold everything. They were afraid that it's going to go down, so they sold. When it's above, that means it's overbought. So more people have bought this stock than what it typically does. So in my opinion, there's a possibility that with a recent spike from $25 to $40, I have a feeling, and sometimes this happens too, that there might be some people shorting, other people will take profit. So I think there's a possibility that this will come down. I could be wrong, but based on the RSI number, I think there's a possibility that price will come down. So rather than spending money to buy overbought stock, I'm going to leverage put options. And for those who are not familiar with that, let me explain to you. So what exactly is a put option? Remember, when I sell call options, that means somebody has the right to buy. In this particular case, when I sell my put options, of course, I don't have to own the stocks, but if the price falls below the striking price, I am obligated to buy them at that price. So let's look at the actual price so that you'll be able to understand what I mean by this. So at 31, if the stock price does not fall below 31, I get to capture 36 cents. And of course, stock price falls to $10, I still have to buy it at $31. So that's the risk that you are taking. But for me, something like that is doable, or even $32, which will give me about 10% return of the stock price. So most likely I'm gonna sell it at $32 and capture 48 cents. And assuming that this is what the market is going to be when I open. Of course, that will fluctuate depending on what the price is on Monday. So to recap, because of the RSI number shows that it's overbought, I am not willing to go and buy back all those shares and do cover calls again. Instead, I want to potentially look at the downside, or assuming that there might be a downside movement with this particular stock, I'm going to sell put option at $32 and capture about 48 cents. So depending on how much money you have, it could be $480 that particular week, or it could be $4,800 that particular week. But without putting my money to buy shares, I'm going to extract that income. Of course, there's always that possibility that it will just tank and you are going to be losing tons and tons of money. But I think there is a market for modular nuclear reactor, so I am willing to take that risk. And again, I bought this at $20. So even if I were to lose half of the money, I still break even. So again, playing with the house money. That's why I'm willing to take this type of a risk. I know this might be confusing, especially for those who have never been exposed to selling put options. I'm sure there are people who have bought put options hoping their stock will go down, but selling put options with amount of cash in order for, just in case it gets executed, this might be something relatively new. So feel free to ask me questions through comments or direct messages. Direct messages I don't get to. Nowadays I get hundreds or close to 500 direct messages a day. So I might not be able to get back to you quickly, but yeah, please like, comment, repost, and feel free to ask me any questions on different way to extract weekly income utilizing what I call, what industry calls selling put options. Hopefully this was useful.